Amanda.
Because I have two invites and I don't know which one's you.
Okay, so I see you. So give me permission to talk. So I'm going to promote you to a panelist. Okay. You, you were bang on time. So all right. Thank you for joining us. Let me just share a few words, and then Amanda's going to introduce our guest today. So welcome to the Harvard Business School Club of San Diego. This is our CEO forum, one of our kind of key events that we do. My name is Edward Hughes. I'm the president of the HBS Club of San Diego. And we're delighted you're joining us today for this is what it looks like to be a very interesting webinar. So thanks again for our sponsors. As a club, our mission is to continue to educate leaders who make a difference in the world and make San Diego a great place to live and work. And we do that really through three key type of events. CEO forums like we're having today, where we bring interesting people in from a variety of industries, across the country. Obviously, since everything's gone online and virtual, we're able to get a much wider group of CEOs come and talk to us. So we're super excited about that. Second is our management development programs. We are fortunate that we run a management development program where in the fall we do a for-profit program. We just kicked it off this week. It's a 11-week program, and we've got about 30 odd people. I kicked off the opening class earlier this week. We're doing HBS case studies there. Fantastic group. We've actually got a few Navy SEALs in that group as well, which kind of makes it very exciting. We had I did a case on Everest and the in '96 and the mission that went badly wrong. It was interesting to hear the SEALs' perspectives because obviously they do a lot on the mission type of activity. So our management development programs kicked off. We are going to be doing a not-for-profit one starting in January. So if you are involved with nonprofit organizations here in San Diego, look out for the emails. We obviously love board members to recommend the CEOs or the some of the senior managers to participate that. And the third thing that we do is really our social enterprise initiative, something we're very proud of, where we feel like making San Diego a great place to live and work is by making sure we have strong nonprofits. So over the last 15 years, we've given about $650,000 to either invest in leaders going to HBS, the Strategic Perspectives and Nonprofit Management Program. I think we've sent 45 leaders to that, or to basically also give money to local organizations to help strengthen those organizations. So those are the three key things that we do. Today is going to be in a webinar format. So it's, the conversation is going to be between Amanda and our guest. I'll drop off the screen in a second. But what we do want to do is make sure that we are addressing any questions you've got. So please type them into the questions or the chat. At the end of the session, I'll come back and help facilitate a few questions that come from the audience. But with that, let me introduce Amanda. She's a former club president as well, and has been on the board for a long time. Terrific person and a great friend. And Amanda, thank you for organizing our guest today. And with that, I will let you guys get into the meat of the conversation.
Well, thank you, Edward, and thank you to everybody who's taken the time to join us today. I am delighted to be hosting today. Firstly, because I work for an asset management firm called Sycamore Tree, also focused on credit markets, and we aspire to be an Oaktree one day. So for any investors in the audience, stick with the trees. And secondly, because today's guest is an HPS 2003 grad and my section mate, section Special K. So good to see you, Armen. Thank you for joining us, everyone. Please welcome Armen Panossian. He is Co-Chief Investment Officer of Oaktree Capital Management. For those of you not as familiar with Oaktree, the firm was founded in 1985 by industry legend Howard Marks, and Oaktree manages around 200 billion give or take, and strategies primarily focused on performing as well as distressed and opportunistic credit. Armen oversees the firm's global investment teams and serves as head of performing credit, managing Oaktree's liquid and private credit strategies. He obviously brings deep expertise built over nearly decades in credit markets. He is also an HBS overachiever, holding degrees from Stanford and Harvard in economics, law, business, and health policy, as well as serving on the advisory board of Stanford's Institute for Economic Policy Research. Armen, great to see you. Welcome, and thanks again for making time to join us.
Great to see you too, Amanda. And thanks for having me on, and I'm looking forward to the discussion.
Fantastic, and we'll get into some market outlook, some credit talk, some sort of industry trends and whatnot. But first, just kind of from a HBS to CEO career journey. When you sat in Section K in 2003, did you know you always wanted to be in credit? And then maybe you can just talk about joining Oaktree. I know that was right before the great financial crisis, so an interesting time and kind of what that was like for you.
It's a good question. So before going to business school, I was a banker for Morgan Stanley in the M&A department. And while I was there, I was actually deferring my admission to Harvard Law School. So I was one of those students in college that thought that maybe wanted to be a lawyer, and decided against that as I entered banking, because I thought that the lawyers are the only people that have frankly, the worst job on a deal. And so I still decided to go to law school because I thought it was a worthwhile education. And so I actually started in 2000 at Harvard Law School, and in my first year, I applied to the business school and got in, and that's why I did the JD MBA. So when I was sitting in Section K, I knew that I was not going to be a lawyer. I knew that I didn't want to be a banker either. I kind of enjoyed the buy side, and I was kind of figuring out what made the most sense. And for me, at least in terms of my interests. And I found that what I actually enjoyed the most was distressed debt. And that was more of an academic, it was based on more academic kind of proclivities. So I really liked corporate restructuring at the business school. I really liked advanced reorganization of the law school. My bankruptcy professor in law school was Elizabeth Warren, who was not a politician at the time, but quite a good, actually amazing bankruptcy professor. So those are the things that I gravitated towards, and less so to things like, constitutional law or criminal law or anything like that, or some of the other more fluffy areas of the business school curriculum. So I knew I wanted to do distressed debt, but when I graduated, there wasn't really much distress. In the early 2000s, after the dot-com bubble burst, and after Enron and WorldCom had their fraud issues, by 03, 04, it was more of recovery time and less in terms of distressed opportunities. So I went to a very small distressed unit of a very large hedge fund called Pequot Cap. And we had, 300 or 400 million under management, pretty small, trying to just kind of not make any mistakes. And in 07, prior to the GFC, Oaktree and others saw that there were cracks in the markets, some of the lending activities that had been going on. And so Oaktree's distressed debt team hired two people, and I was one of them. So it was, at the time, kind of like the dream job for me. I mean, I'm from LA. It was an opportunity to stay in LA, work for the largest distressed debt manager in the world. By reputation, Howard Marks and Bruce Karsh, the co-founders of Oaktree, were just, by all accounts, great people to work for in terms of sort of personal behavior and interaction, but also in terms of being investors, considered among the best, specifically in the distressed debt camp. And so I joined in June of 07. My oldest son, who's now 18 and in college, was a month old at the time. And it all worked out because since then I've had 3 other kids, and I've survived at Oaktree and had a pretty good career thus far.
And remind us, I think it was about a year ago you stepped into the co-CEO role. Can you talk a little bit about that and maybe why co-CEOs and benefits and challenges that come with that?
Sure. Yeah, and I think the co-CEO thing is more a function of Oaktree's history. When Howard and Bruce started Oaktree, they were effectively co-decision makers. They were partners. They didn't have a CEO title. And in 2000 or 2001, they hired a managing partner who was actually a lawyer from Munger Tolles, and he was running sort of the operational part of the business. And even his title was not CEO; it was managing partner. And then Howard and Bruce were sort of the real decision makers around the strategy of the business and how they invested. The first time we had a CEO was actually when we went public, or right after we went public, actually, in 2012. And we hired a CEO that was formerly from AIG, Sun America, and he was very much operationally minded. But then in 2019, we were taken private by Brookfield Asset Management. They bought a majority of the equity of Oaktree. And so the founders of Oaktree then kind of said, okay, well, how do we want to be structured now? We don't really need, CEOs per se, but we want to go back to the environment where the investment team was controlling the strategy of the business. So they looked at and because they were used to the idea of co-heads, and from an investment standpoint, they said, okay, well, who does it make sense, either a single CEO or a co-CEO? And so they tapped myself and my partner, Bob O'Leary, who is also an HBS grad. I want to say it was either 2000 or 2001. And they asked us to be co's. Now, the reason they asked us to be co's was because, Bob runs our distressed debt business, our opportunistic credit business, and has been in that strategy since he joined Oaktree in 2001. I started off in that same strategy in 2007, but in 2014, I left it to go build other businesses around the firm after we went public. So go public in 2012, they said, okay, well, we need to build up our non-distressed businesses because now we're public, we need to be more balanced. So I started doing things like senior loans and CLOs and structured credit and multi-asset credit, and really building up what we were doing in the performing credit side, and eventually took over what we do at all the different things that we do in private credit. And so when the decision was being made as co-CEOs, they said, these two people have worked together very closely for many, many years. They know the inside of Oaktree very well. Between the two of them, they oversee 150 billion of our 200 billion under management. And so that kind of is a natural, as long as they're sort of relatively well liked within the organization, it's a natural fit to kind of tap these two. And so that's kind of how they chose it, how they chose sort of who does what. And I think in this instance, it works very, very well because Bob and I know each other very, very well. We trust each other implicitly. So I defer to him on the things that are in his domain. He defers to me on the things that are in my domain. We run things by each other when we need to. Like, if I'm going to do something strategic or transformational on my side of the house, I do ask him, like, hey, what do you think of this or that? So it's very much a friendship, a partnership, and mutual respect. It's not like we're thrown into a co-CEO situation and we're having to kind of fend for ourselves and we're trying to one up each other. And there's no oddity in terms of having that co-relationship because our lanes are quite disparate and well defined, and we trust each other's capabilities to execute within those lanes very, very well.
It sounds like a very good marriage.
It is a very good marriage. Yeah, sure.
Great. Well, maybe we'll move on to markets, which everybody wants to talk about and hear about. And before kind of a deeper dive into maybe some of the trends and things going on in credit, here we are on Jobs Friday with no jobs numbers and day 3 of the shutdown. Can you maybe give us kind of Oaktree's house view and some thoughts there?
Yeah, I mean, it's really hard to figure out what to do. I mean, there's the way we break things down at Oaktree is we look at fundamentals, technicals, and then regulatory, or just government. And usually that regulatory piece of it is not a driving force, but obviously these days it is. So you have to think about that. And that today, there's actually some meaningful kind of events that we're watching and are about, and we think or could potentially impact the economy. We'll talk about that in a minute. But in terms of fundamentals, the fundamental performance of businesses, I would say, is good. It's not great. Generally speaking, companies are passing through cost increases that we've been seeing over the last few years. We're seeing revenue growth, but and this is a generic statement, and obviously every industry and business is different. But generally speaking, companies in the below investment grade area that we operate in are seeing flat to declining profitability, even though revenues are sort of flat to increasing. In addition to that, the highly levered, private equity positions, I think, are troubled. Those private equity firms are getting long in the tooth on their hold periods generally, to the extent that they made a lot of money just doing financial engineering for the last 10 years. That doesn't work in the current market environment. So I think, we're looking at the kind of the soft underbelly of the market, or of the issuers out there. And where I think it is especially acute is in broadly syndicated loans. And I would say it's in the worst sort of 10 to 15% of that market that we're watching very closely and mining for distressed opportunities. In our performing credit area, that's the area we're avoiding. We're saying, okay, well, look, we're not going to only buy the super, super low yielding safe stuff. We have to buy things that are representative of the market. But we want to avoid the default risk. We want to avoid the loss risk. We want to generate a portfolio that is well diversified and is going to have a sort of sleep at night coupon and income generative potential. So that's what we're doing on the performing credit side, sort of avoiding bad outcomes, because we do think that there are some bad outcomes out there that are unfold over the next 12 to 24 months, as these businesses have been starved for capital for an extended period of time, as the private equity firms have overpaid for those businesses and not realized on their synergies. That isn't the average issuer in the market, to be sure. It's sort of the tail but at this point, the broadly syndicated loan market in the U.S. is about 1.4 trillion. So 10 to 15% of that is not a small number. And so we're watching that closely, and the fundamentals, kind of breaking them down. How bad does the worst piece of the market look? How bad does the average look? And I would say the average performance of companies that we watch is not alarmingly bad, but it isn't incredibly good either.
And Armen, you would probably have some folks on the line who aren't investment professionals per se. So when you talk about the broadly syndicated loan market, can you just kind of describe what kind of companies those are?
Sure. So, I mean, I apologize. Maybe there's a range of people on the call that don't know what that product is, but broadly syndicated loans are essentially liquid loans that trade in the market, and they're originated by banks for the purposes of syndication to folks like us and investors that buy slivers of these loans and put them into diversified portfolios. So it's technically not a security, but it's like a high yield bond or an investment grade bond. So it's kind of like a security, even though from a legal standpoint, it's not technically a security. And so you could sort of easily trade these securities. There's a market for them. There's an index for them. But that market today, it has about 1,500 issuers in it, about $1.4 trillion of issuance, and probably about 70 to 75% of that market are borrowers that take on that debt in connection with an LBO. And that means there's a private equity owner that levered as much as possible to buy that company. And when they went to market that business to this set of investors in that broadly syndicated loan market, they told a really great story of saying, look, I know this company has 100 million of EBITDA, but under my ownership, it'll be 125 because I'm great at cutting costs and expanding businesses at the same time. And so they levered it off of 125, not off of 100. And since then, we've had COVID, we've had inflation, we've had tariffs, and some businesses did actually really well through that, and some businesses did poorly through that. And what I'm saying, in some cases, all of those synergies, those good things that the private equity firms were going to do, just haven't panned out. And that isn't, again, that's not the base case. That's not every issuer. That's not even the average issue. But it is about 10 to 15% of that market. And they're, I would say, by and large owned by private equity firms. And they're by and large in these broadly syndicated loan formats rather than in high yield bonds. And the reason for that is broadly syndicated loans do not have call protection, whereas high yield bonds do. Broadly syndicated loans are floating rate in nature. They're priced at SOFR, standard overnight rate, plus a spread. And because and by the way, before SOFR, it was LIBOR. And because LIBOR and SOFR were so low for so long post global financial crisis, the expectation was that they're just going to be low forever. And so, LIBOR was at 25 basis points for most of the last 10 years, pre-COVID or pre-rate hike. And so you were pricing it at 25 basis points plus a spread of 3.5%. So those borrowers were, borrowing at 3.5 to 4.5% generally, with the ability to constantly reprice their debt tighter in terms of its spread if the business does well. So the optionality was quite valuable to private equity firms. Now that same optionality goes in the opposite direction when rates rise. And rates went from 25 basis points to 5% on SOFR. That, SOFR's at 4.15 today. But that escalation of rates was not anticipated by anybody on the private equity side. And by and large, they didn't hedge. They didn't fix SOFR or LIBOR at a really, really low rate. And so they have seen a massive escalation in the cost of their borrowing. And as a result, between that and some of the bad things happening to those businesses, to some of those businesses through COVID and inflation and tariffs, they are seeing a reduction in EBITDA or profitability and an escalation in their cost of borrowing. So they're starving that business of investment and have been for quite some time. So that's kind of the risk factor in it. And high yield bonds, it's different. They're generally speaking are fixed rate. They are usually 7 to 10 year maturities. They usually have something like a 3-year non-call, so you can't repay the debt without paying the full sort of extended life of the coupon or 3 years of the coupon. And even after the 3 years, they have an elevated call premium. So in year 4, you could pay down that bond at par plus half the coupon, and then the year after it's par plus a little bit, and then after that you could repay it at par. But that means you have 5 years of call protection. And so as a private equity firm, you don't tap that as a financing tool generally. So who are the borrowers in high yield bonds? They tend to be bigger businesses that are taking on the debt for strategic growth initiatives. They're not in connection with an LBO. So they tend to be, you got to think of it as like a public company or a family-owned company or an entrepreneur-owned company that is big and able to go through the brain damage of ratings and syndication process for issuance of a high yield bond, like on a regular basis. They're usually not one and done. They usually have like a series of these things. So they tend to skew larger. That market is also about 1.4 trillion, but it has about 800 borrowers. So again, 1,500 borrowers in broadly syndicated loans, 800 in bonds, and roughly the same size of the market. So skews towards larger borrowers. And those borrowers on a total debt to EBITDA basis are actually less levered than the broadly syndicated loan market is on a first lien debt to EBITDA basis. So a lot of risk factors in the broadly syndicated loan market. Those risk factors don't exist to the same degree in the bond market. And as a result, by the way, the bond market is the highest rated it has been since prior to the GFC. The percentage of double B rated bonds is higher. The percentage of higher quality single Bs is higher than it's ever been. So that market has been de-risked over the last 10 years. And so, a lot of people talk about spreads and they say, wow, at 280 basis points in high yield bonds, that's pretty tight relative to where it's been. And the historical average is sort of 300 to 400. A healthy average is 300 to 400. But the healthy average of 300 to 400 was at a time when you actually had a higher degree of worse credits or a higher proportion of worse credits. So that kind of bleeds over into the technical picture. And technicals really speaks about fund flows. Are there funds inflowing or outflowing from credit right now? And generally speaking, they're inflowing. Now, it depends on the week, depends on the month, but on a retail basis, on an institutional basis, high net worth basis, it's all been generally inflowing for the last few years. And some of it is because of risk concerns around equity. Some of it is concern, so sort of pivoting away from equity to debt. Some of it is, I really like having my contractual coupon. The power of the coupon is meaningful, and the power of a maturity is meaningful. So I like that rather than having sort of equity that's open-ended and may move up or down. In a higher rate environment, being a creditor is generally better than being an equity investor, because you think of sort of the pie of corporate value at a higher rate environment, more of that pie is skewed and handed over to creditors and equity owners. So as an investor, you have to choose to be an asset owner or an asset lender. If you break down all things in investing, that's really what it is. You could just break it down between those two categories. And in this environment, generally, it's better to be an asset lender rather than an asset owner. And there's a lot of research around kind of PE multiples historically and what that implies for forward PE multiples. So there's just a general sort of buying behavior that favors credit right now. Now, obviously, we're seeing a lot of interest in equity too, but specifically, I would say in the AI story and tech story, if you really break down, what's kind of driving the equity markets, I think that tone of AI and productivity gains from AI, plus the expectation that rates are going to decline even further from here, that's driving equity flows pretty meaningfully this year. So the technical right now is quite strong in both directions. The last thing I'll say about the technicals is, with all the stimulus dollars printed during COVID, those dollars didn't go away. They got printed, they got sprinkled across the economy. Business owners and corporate treasuries and wealthy individuals accumulated, sort of hoovered up all that value. And you're seeing that wealth effect really kick in, especially in the sort of upper middle class and the very wealthy parts of the US especially, but that's true globally too. So you're seeing it in what you hear about what the complaints that wealthy people make. It's, can I get my Ferrari in the color I want on the time frame I want? Can I buy a sports team at a price that that I would like to buy it at? I mean, these are the kinds of things that super uber wealthy people are complaining about. They're not complaining about milk prices or egg prices or gas prices, but there's a meaningful part of the U.S. economy that is complaining about those things, in childcare and very basic necessities. And so the economy certainly feels like there's a haves and have-nots element to it. And the haves are very, very wealthy and well off, but the have-nots are pretty weak. So we're watching that. And I know, Amanda, you're probably going to ask me, like, what sort of indicators do you look at? We do look at how much of the U.S. population is delinquent in its debt, and we sort of double click to look at that lower income population, what sort of industries they shop in or buy in.
Great. If I could kind of pull us a little bit back and
Sure.
higher level, you mentioned private equity, a couple times in there, private equity, which is actually maybe struggling or has the last couple of years, and obviously public equity has been on a tear. Now you see more people rotating into debt, fixed income, and credit because rates are higher. But the buzzword of investments today is private credit. Can you give kind of a like dial it back to like higher level, like what that story, kind of the evolution of private credit and what that looks like today, and how public-private credit, that pendulum could potentially swing back in the future, and just kind of give us the landscape.
Yeah, they're very topical right now for sure. So first of all, prior to the global financial crisis, private credit as a market was less than $250 billion. Today, it's about 1.5 trillion, and by all accounts, heading to like 2 trillion in the next 3 or 4 years. So huge growth. And your question is like, well, why that much growth? And what is the pendulum going to swing? Very, very important questions. Now, why did private credit go from 250 to 1.5? And that's really because coming out of the global financial crisis with Dodd-Frank and leveraged lending guidelines, which were sort of instituted by the Office of Comptroller of Currency and the Fed on the member banks, resulted in a diminished amount of lending that the banks were doing. And so this shadow banking market started developing sort of 2012, 13, 14. It wasn't material, but that was sort of the nascency of first lien lending to private equity sponsors doing new deals. Like, that was not something that historically had a real market to it. But there were some early entrants in that time frame. They went out there and told the story of like, hey, this is something that's really good for investors because you're going to pick up 150 to 300 basis points of incremental spread, and you could trust us. We're credit experts, and we're going to put a lot of structure and a lot of legal protections on these businesses. And that story, by and large, now this isn't true of all investment managers, but by and large, that story has played out. What happened is, from 2014 to 2024, the market in terms of the market grew in terms of borrowers or private equity firms willing to borrow that way, willing to borrow privately rather than in the broadly syndicated loan market. Now, why is that? In some cases, the deal was too small and it didn't make sense to go and syndicate a loan. In some cases, the deal had a little bit of a story to it, and it was better to have a conversation with a single lender rather than 40 lenders from a syndication process. In some cases, they wanted a private equity firm or the company wanted to keep it super quiet because they wanted to be stealthy and they didn't want to air out kind of all their information. And for those variety of reasons, the amount of deal flow, the number of deals, of possible deals to choose from in the market grew. That the stability of the income and the yield pickup was evident, and they did not give back a lot of that return through defaults and losses. Now, some critics of private credit say, well, yeah, you didn't give back. You had a lower default rate than the broadly syndicated loan market and the high yield market, not because there was less risk. It's because you as a lender, as a single lender in a bilateral relationship with the borrower, decided not to call a default. And you just kind of kick the can, and that's BS, and you shouldn't, that's not apples to apples comparison. And by the way, there's some truth to that. A lender, other than folks like Oaktree's distressed debt group, don't actually want to own their borrowers. And so, if you have 10 deal or 5 deals with, I'm just throwing out a name out, Silver Lake Partners, and you have one of them going bad, you kind of don't want to take that one back because you have 5, 6, 7 of them that are working well. And so it's kind of like, it's a long-term relationship. And so you play ball on not taking away businesses from those types of partners. That certainly did happen with private credit, but with not enough of an incidence that it damaged the product or the legitimacy of the product. Most investors in private credit for the last 10, 15 years, 10, 12 years, I've been actually very happy with 2 things. One, the stability of the income coming off the portfolio. So defaults and losses are manageable. And 2, the stickiness of the marks. And if you think about it from like a pension standpoint, when you have a board and you want to report the performance, having very sticky marks and very dependable income is a great thing. Makes you look good, rather than volatile public marks that you could have. Now, that explains kind of the growth and attraction of the product. That growth and attraction is also relevant for retail. So high net worth individuals now have semi-liquid BDCs, business development corporations, that are publicly filed, but don't have public equity. You have to kind of buy them through your private wealth manager at one of the wirehouses, at one of the banks. And so there's been sort of a second wave of growth in the last 4 or 5 years because of the sort of they call it the democratization of these kind of alts areas. I don't like that term. I can tell you why, but that has been the trend pushing private credit. Now that trend is entering private equity. There are now these types of high net worth vehicles for private equity to democratize private equity for high net worth individuals as well. Which the reason I don't like it is to say that is sort of a euphemism for lobbying really effectively to get to sort of lower the standards on what could be sold into sort of retail hands, and that's all it is. It's sort of it's selling a product because those managers need to find an offtake of their existing portfolios to now a new set of buyers. There's a little bit of a skeptical view on this. I mean, if you want to dig into it, we could dig into it. But
yeah, no, I was gonna ask you. So as asset managers, right, because there's so much growth in the retail and the wealth channels, want to move into those channels, and there's appetite for private markets, private equity, private debt. Do you foresee some blow-ups on that front? And what are your thoughts and opinions on private markets making their way into people's 401ks and investments like that?
So I mean, I do foresee blowups because even though the legal documents are quite clear that these vehicles have capped 5% liquidity per quarter, all it takes is for some wave to occur where there's a lot of redemptions happening at one time and not being met or just being effectively queued for the investor base to say, this wasn't what I thought it was. And I think that we did see one pretty meaningful instance of this during COVID, where there was a REIT. I'll refrain from using the names of competitors, but there was a REIT that was not gated. It's not gated like
Which is, again, just real quick, Armen, a real estate investment trust for those
yes, a
listening who
real
don't know
estate
what a REIT
investment
is.
trust. So it was a privately distributed, not a publicly traded company, real estate investment trust that had high net worth individuals as the buyers, and they were worried about COVID, and they put in redemption orders for their positions, and so there was 5%. It was always communicated that there would be 5% maximum liquidity per quarter on the way out. So as it looked like there was a queue developing, everybody rushed to jump on the queue because it's sort of first in time, first in right type of thing. So that had some meaningful repercussions. And some of those investors said, wow, I feel like I got burned. I was told this is liquid and it's really not. So there is potential to have a mismatch in assets and liabilities. The assets in the case of a REIT or real estate investment trust are typically loans or real estate assets owned, and those are very long-term assets that cannot be sold readily. In the case of direct lending, those are also assets that can be sold, but there isn't really a market for it or a robust market for it. And then the liabilities are cash withdrawals. And the managers of these types of entities, ourselves included, do communicate the 5% limitation. And it's up to that manager to manage the portfolio in a way where you could have liquidity beyond that 5% in a worst case scenario where you say, you know what, even if I get hit with more than that, I'm still going to make those redemptions because I want to make sure my investors have a good experience. In private equity, these same vehicles, but for private equity, have less liquidity. I believe they're at 2 or 3% per quarter. But I don't know how to word this. The asset class of private equity in retail is very, very important to the private equity firms. It is interesting and novel and cool for the high net worth investors. Yeah, now I have these assets too, and it gives the opportunity for the client service people at various wirehouses to sell an additional product and earn a fee. So everybody's sort of attracted to that. They like the idea of earning fees. The high net worth individual likes the idea of adding an asset. But the private equity firms must generate this market. And why is that? It's because the institutional investor base of private equity is really, really full on private equity. They're not you need to see exits from private equity, from a private equity fund to generate a new check to the next private equity fund from a big pension or a big institutional investor. So who's the offtake? The offtake has historically had been the public equity markets and other private equity firms. The other private equity firms are stuck. Their positions are getting extended. So, there's sort of sand in the gears there. And in terms of public equities, the market's going the other way. There's actually fewer public companies today than there was 8 years ago or 5 years ago. So and they're skewing larger now. And so it's kind of that's not an offtake. That's or a viable offtake. So, but if you could raise 15, 20, $30 billion from new investors that are uninitiated in private equity, then you have now an offtake even for your own portfolio. So some of the things that some of the private equity firms are doing with these new retail vehicles are saying, okay, I have this institutional PE fund. I have this company in it. I'm going to sell a 15% interest in this company. It's a great business. I'm going to sell 15% interest to my competitor, and I'm going to sell a 15% interest at the same price into my own retail vehicle. And so they're kind of throwing fish in the boat, doing things like that. And you could make your own judgment as to whether that's a good thing or a bad thing. Some people like it. Some people think it's rife with conflict. So it's something to watch. Now that's not really true of private credit. Private credit in retail has not become a thing because there needs to be an offtake. It's become a thing because people like having income that is at a spread pickup or a return pickup versus what's available in below IG credit, below investment grade credit, like high yield bonds or broadly syndicated bonds.
Gotcha. Okay, I'm going to switch gears because this was a question on my list and we have one in the chat too. but just wanted to ask you more broadly about AI and how you see that affecting financial services and your business particularly. And then we have a question here that's pretty specific. It's from one of our classmates, so I'm going to give a shout out to Saba. He says, do you foresee AI having a greater impact on the cost efficiency side or revenue growth? And do you see a difference with heavy PE-backed firms versus those in public markets?
Okay. Well, look, I think AI, it's both a risk and an opportunity. The opportunity is obvious. I think the opportunity, at least initially, is on the cost. And it's because I don't know how to predict the ramp on the revenue side. Could you charge more for AI-driven intel? The answer is yes. I'll give you an example. There's a company, I don't know if I should, I mean, it's a good company, I don't mind saying it's called Gecko Robotics. Private company. They make robots and drones that crawl over infrastructure to evaluate how damaged that infrastructure might be on the inside, like repairs and things like that. There is a revenue opportunity there, right? In terms of like this company selling its products and really adding value. There's a cost savings too, because the owner of the infrastructure avoids costly downtime, and the insurance companies that insure that infrastructure, avoid paying out losses. So there's both a revenue and a cost opportunity there in AI with a company like that. But generally speaking, for an existing business like an Oaktree or an investment manager broadly, the opportunity, I would say, is more on the cost side. And if you think of companies, if you think of sort of pre-AI types of businesses like law firms and investment managers, it's a pyramid, right? There's a lot of junior people, fewer kind of mid-level, and even fewer sort of portfolio managers. My view of it is AI kind of narrows that pyramid. You still need junior people and mid-level people and all the way up, but the productivity of the junior people and the mid-level people becomes heightened by the availability of AI. So you don't need as many of those folks. Now, I don't think we're there yet, but I think that's the direction of travel on the cost side for sort of old school, financial services or sort of white collar industries. The blue collar industries are the more interesting ones because something like a Gecko Robotics is a blue collar, or it addresses the blue collar. But I don't think AI right now is there to a point where we know how that's going to impact the blue collar industries. And they may have an opportunity because there's been a general reduction of trade oriented education for the last 30 years. So there's going to be, I think, sort of an opportunity there for AI businesses to go after that old world sort of hard asset based industry and make some money. But that's in the future. I'm not smart enough to know what that looks like. I am a little bit worried about the social implications of kind of a reduced workforce, because a lot of the impact that the AI is going to have is really on, again, sort of white collar jobs. It's on doctors, radiologists. It could be even like checkout clerks. I mean, this is kind of borderline blue collar, but like checkout clerks at grocery stores. There's 3.4 million people that work in grocery stores. I mean, that's not a small number of people to be out of a job and needing to be retrained. That's a very dumb and small example, but that's still millions of people. So I'm worried about what do those people do. The AI proponents say it's okay. There's going to be so many new opportunities that we can't even predict, that those people have an opportunity to kind of migrate that way. There's going to be just like the internet. The internet, when it came forth, it created jobs. Some jobs were lost, some jobs were created, and that's what AI will be. And so that could be true, but I am worried about the social ramifications of a meaningful and fast shift in AI. Now, the other thing I would say about AI in terms of financial services is that it is intoxicating to folks like us when they see these big dollars of deployment opportunity in fiber optics, in cooling systems for data centers, in you name it, power. So when you look at the sheer dollars that need to be spent to sort of fulfill the AI dream, it is really kind of mind-blowing. And so I think for a while there will be some great opportunities, but I am very concerned that eventually, as it has happened in other industries, there will be speculative construction and speculative projects. That's not the norm right now, but the direction of travel is that way. And the cost of borrowing for AI-oriented infrastructure build has come down. For example, CoreWeave, a couple of years ago did a GPU financing at a fairly high rate. They just did another one at like 300 or 400 basis points tighter. Same deal, 400 basis points tighter. So the acceptance of AI and the future potential of it is quite strong. There are huge dollars being raised from especially sovereign wealth funds, but other institutional investors to go after that opportunity set. And by the way, we're doing it too. So I can't like point the finger at anybody, but at some point there will be a poster child for excesses in AI lending or AI investing. And I hope that we're not one of them, but there will be. Absolutely. I mean, going back 25 years, Global Crossing, I mean, maybe some of you remember that name, but Global Crossing was the poster child for a similar excessive build out, which was in fiber optics undersea. And all of that fiber is now obsolete. It is just they were early to that build out, and to the point where it wasn't even contracted, and now it's useless. And so, Howard Marks, our co-founder, one of the things he says, I'm not sure if he's quoting somebody else when he says this, but he says, being early is sometimes indistinguishable from being wrong. And so, you might be right, but you're early, like Global Crossing was, and you don't have a business anymore. That could be true for some AI or data center projects out there. I don't know if I answered the totality of both of those questions, but I think I got close.
Good stuff. Speaking of being wrong, do you have any, I'm going to throw this one on you. Do you have any good examples where Oaktree has been wrong and what you learned from that?
Yeah. I mean, there are definitely examples where we got things wrong on the investment side. Sometimes we were early to something. I'll give you an example. We were part of the team that restructured TXU, the largest, prior to the Electronic Arts LBO, was the largest LBO in history. We restructured it. We owned that for a long time, owned the equity at post-emergence. And our funds were getting kind of long in the tooth, so we sold that public equity. That stock has been like a huge winner from the AI boom because they're a massive power provider in Texas. But I think you want something a little bit more fancy than that. But there's always things like that where small mistakes. I think the big mistakes are when there's fraud that occurs, and we generally don't get ourselves on the other side of that. We do background checks on borrowers, especially when they're non-sponsored. So we generally do a good job of avoiding that. It happens from time to time, but I think that's one example. I think that from a business standpoint, or to put my CEO hat on and not my investor hat on, I think the biggest miss on our part, coming out of the global financial crisis, we were like the darling as a firm. We had the biggest pool of distressed debt capital. Between when September of 2008, when Lehman collapsed, in March of 2009, when I think President Obama called the bottom, we were investing $500 million a week. And by 2011, 2012, it was clear that this was like a home run opportunity, the best buying opportunity from a credit standpoint, at least of our generation, et cetera. And I think we had a lot of credibility with our clients. We still do, but we then sized our next fund down from there, cut it in half, which generated a lot of credibility with our clients. What we missed, however, was that there were a lot of distressed firms out there, private equity firms, infrastructure firms, you name it, but outside of distressed debt. Distressed debt, the way we did it, did really, really well. We could have, should have, would have bought some other managers and really diversified what we do. At that moment, that was our chance to really diversify what we do outside of credit. But what happened was, our leadership said, no, I think we got a good thing going. Why do we want to sort of, venture out in an area that we just never really felt comfortable with, just because it looks scratched and dented or cheap or distressed, and we always thought about investing our funds and never our balance sheet. So when we looked at XYZ private equity firm that's damaged in 2012, 2013 with they have no carried interest, everybody may leave. We said, well, we don't want to put our funds into this. It's just we don't want it. We've done a good job. We have a lot of credibility with our LPs. Why would we put this in there? What we never thought about was, well, should we just buy it out of our balance sheet and spend a little bit of money and diversify our business? And we just never did that. I think that was, in my career at Oaktree, probably the biggest mistake.
Fair enough. Fair enough. And I'm looking at time too. We've got about 10 minutes to the top of the hour. So if anyone out there has questions, go ahead and throw them in the chat now. And Edward, feel free to jump in and read any of those off. Let me see, what other questions do I have? Or I'll pause for a second, Edward, to see if you have any already.
A question for you as a, obviously you got incredible technical knowledge of the markets. How do you think your impact is as a CEO? How do you view yourself as a leader, and what do you do differently? Because obviously you're not doing the day-to-day investing yourself. You're now managing a whole group of professionals. Maybe you can talk a little bit about that.
Great question. So look, I think that my job as a CEO of an investment management firm may be different from a CEO of a different industry, but it's sort of there's an internal role and an external role. The internal role is to make sure that I'm giving the support to the people at the firm that are driving new business, and to give them the backbone or support to say no to things. For example, like, it's okay to just not invest for a quarter in something, like, or two, and just say, you know what, it's fine. Even though that means we don't call capital and we don't generate profit or more profit, it's okay. Like, there need to be people at the top of any firm, like an investment management firm, that say clients come first. We got to protect their capital. We have to do a good job with their capital first and foremost. If we don't do that, then we don't have a business. So that to me is a very important piece. It's sort of being fine with saying no to things like that, where it's when it's good for clients, but it's also making sure we rally the support of the organization when we're trying to do something new. So, there's a PM that wants to do something new, and let's look at it. Does it make sense? Does it instead of putting up like just hurdle after hurdle after hurdle, which can happen with managers when they don't feel comfortable with a particular industry, they're more of an administrative manager rather than an operator themselves. They may just put up hurdles and committee after committee after committee to be the sieve in preventing potential growth from happening. My view is I know this business really well. I know the people really well, and so I have a pretty good barometer for kind of what makes sense and what doesn't. And with the things that do make sense, let's just bring down the hurdles and just get it done quickly and make sure that we're all kind of rowing that direction. So that's the internal mandate. It's to generate buzz internally. It's for people to be happy to work here and excited to work. And usually people in most businesses want to grow. They want to personally grow, and they want the business to win. And as a CEO, that's got to be a huge priority. The external is making sure that we are interfacing with clients and just stakeholders externally, that in a way that is transparent, is fair, is respectful, and gives the client what they're looking for. I mean, client service is super important to what we do, and there's a quantitative or objective part of that, and then there's a subjective part of that. The objective part of it is, if a client wants data about certain things on a certain time frame, you got to present it. So that's like table stakes. You got to make sure that your systems, your people know that client service is key. You got to get that. It's got to be correct. It's got to be fast. The subjective part is talking with clients and having them, or explaining to them why we did certain things and what worked and what didn't work. And in a way that they feel a sense of a tone of partnership, rather than either you're talking over their heads or you are really reducing the complexity of what you're talking about because you don't think that they can handle the complexity. So that's a little bit more EQ oriented, but it's super, super important because I've seen it go the wrong way. I mean, I've been in meetings where I'm like, oh, I went really badly with, where it just, maybe others say the same thing about me in a meeting. Like, wow, Armen does not have that figured out very well. But that's kind of the external mandate.
Armen, given those comments, I think I know what you're going to say, but do you think asset management firms, generally speaking, are better off being publicly owned or privately owned, and Oaktree has been both.
Yeah. Well, purely from a elimination of conflicts perspective, it's better to be private. If I were as an LP and I was talking with a publicly traded manager, I would say, well, your motivation is to have as much AUM at IFE as possible and just deploy. Whereas, what you're telling me I should buy is something really unique and special and whatever. And I kind of don't want you to raise $10 billion in the strategy. It's kind of supposed to be $1 billion, $2 billion. So, and so that conflicting motivation for growth is palpable when you're a publicly traded investment manager. On the flip side, having a public equity helps with attracting talent. You have a currency. You have a currency to provide a partnership interest to an employee that has over time some liquidity. Being private, you don't have that benefit. So the long-term incentive programs that we have in place are just not as aligning, to be honest with you. Like, we have a private equity that is owned for the most part by Brookfield and by some of our employees, but our liquidity is through selling it to Brookfield. It's not through selling it or otherwise monetizing it. So that's not the deal. That's not great. So I don't sort of lean very hard in terms of anti-public, but that's generally, like, if I were in the shoes of an investor, of an institutional investor, I would have a little bit of my spidey sense up on a publicly traded GP.
Fair enough. What do you hope your kind of leadership mark that you want to leave on Oaktree will be?
Yeah, I mean, I think I am thankful and lucky that I inherited a business that is strong. It's doing well. It's a good reputation internally and externally. People are generally happy to be here. I think people feel sort of seen and heard. Those that want to do something that's consistent with our investment philosophy and our strategy and want to kind of venture out, I think they have the support to do that. So it's not a broken business that I inherited, and so it doesn't need to be fixed. So my job number one is just don't screw it up, to be honest. I mean, I just don't want to screw it up. And I just want the firm to grow in every way. I want the firm to grow in terms of the number of people that work here. I want the firm to grow in a reasonable way as it pertains to revenues and profitability. Not because it's a competitive thing, but it's because I think that's kind of, at the end of the day, what makes people happy. They feel happy that they have opportunity at their jobs to kind of do more and expand, and that comes with some ability to sort of pay more as well. So I want our people to feel proud of being here, but I also want, I think personally, I want our investors to feel with me and with Bob that they have the same level of paramount importance as our constituents as they have had with Howard and Bruce. Howard and Bruce, I think if you ask them, if you talk to them in a very candid way, they would both say, we are wealthier than we ever thought we would be. That we're wealthier than we ever planned we would. And so we are happy above everything else that we delivered products and services to our clients in a way that was consistent with their expectations. And when it wasn't, we were super honest and transparent as to why. We feel like we have a great relationship with our client base. And that is the most valuable asset at Oaktree. I think it's sort of tied neck and neck with our people as our relationship with our clients. And so I don't want to damage one or the other. I want to improve both. And I don't think that I could meaningfully improve our relationship with our clients because I think Howard and Bruce did a great job. The only thing I can do in that regard is to continue to communicate with them in a way that's super transparent, super respectful, super open, and deliver good results for their portfolios and their constituents. I know I'm kind of dodging the question, Amanda.
No, you're not. And we're coming up to the final minute here. I'm just saying, Oaktree is a class act, and so are you, Armen. So Section K to 2003 is very proud of you.
And we're the last Section K, right? You know, there's
Here's
no
the
section
last
K after
section
us.
K.
Yeah.
Special K.
Special
Yeah.
K. Exactly.
Special K. So maybe I'll leave, maybe you can leave us on one final answer, which is if, if you weren't running co-running the fantastic firm that you're running today, what would be your dream job? What would you have done? And I'll just share with the audience that Armen had a talent in our section of being able to impersonate almost every single person. So I don't want to influence your answer there, Armen.
Well, I wouldn't do that. That both won me friends and won me some pretty crooked views because when I made fun of people to their faces. But look, I mean, I grew up in a family that my father is a contractor, a builder. Always spent a lot of time in my youth and on job sites and digging ditches and things like that. I like the process of construction, and in the case of Oaktree, it's not physical construction so much as it is institutional construction. So I enjoy that part, but I do love physical construction. I like the idea of like building things, and that's why like a Gecko Robotics, I mentioned it because I think it's just a cool company. So if I would be probably doing something around that, something either in the construction world or startup world that relates to providing a product or service in the physical world. Not the AI, the cool AI algorithm or LLM. That's just not me. But I'm more like a physical. I need to see things. So I think that's what I would do. Something in the construction industry or real estate industry or something like that. I don't know. Good news is I don't have to think about it. I think this is probably one way or another. I think this is my last gig. And we'll
all right,
see
Armen. Well, I'll leave you on this. Don't screw it up.
Yeah,
And,
exactly. Don't screw it up.
Thank you for taking time in your busy day to spend time with us today.
Thank you. Thanks, Amanda. Thanks, Edward.
And thank you again,
for
everybody, for joining.
Thanks, Armen. Thanks, Amanda.
Have a good day.
Have a great weekend.